Within the spectrum of mutual funds, an emerging category is gaining popularity among investors, which is known as a fund of funds or FOFs. One of the biggest advantages of FOFs is access to a diversified portfolio of mutual funds through a single investment. Instead of investing in multiple funds individually, FOFs provide the convenience of gaining exposure to various funds with different investment objectives. For novice investors, they serve as a great entry point. FOFs provide a diverse selection of mutual funds that invest in a range of assets and securities. This can assist new investors in gaining exposure to various asset categories and creating a well-rounded investment portfolio. In this video, we will try to provide complete information about FOFs in a brief manner, and we will be covering the following topics ranging from what exactly are FOFs to their types, pros and cons, taxation, and selection. But before we move any further, hi, I am Pratap Nerula, investment consultant and educator, and if you like my video, please put in your likes and subscribe to my channel. Also, ring that bell to get all future notifications from this channel and put in your feedbacks and comments. Further, put in your questions in the comment box and I shall get back to you on the same. Now coming back, what exactly are fund of funds or FOFs? FOF is a mutual fund investment scheme wherein the pooled capital of investors is invested in another mutual fund rather than diversifying into equities, bonds, or other asset categories. This helps investors create a portfolio of mutual funds instead of direct exposure to stocks, bonds, or other securities. This also means that the underlying investments for an FOF are the units of other mutual fund schemes. The FOF works in two ways, wherein the fund manager has the flexibility to invest in a single fund or a combination of funds of the same fund house or from different fund houses managed by different fund managers. By investing in units of the selected mutual funds, the fund gets access to the return of their underlying securities without investing in the securities directly. The portfolio is designed to suit investors across risk profiles and financial goals. The investors get an opportunity to benefit from the diversification as a result of investing in numerous fund categories. The fund manager of an FOF seeks out mutual funds whose investment objective, risk profile, and strategy align with that of the FOFs. The main objective is to create wealth over the long run. FOFs can invest in domestic mutual funds or give investors a unique opportunity to get exposure to foreign markets through a foreign FOF. In a foreign FOF, the domestic fund invests its capital in the portfolio of foreign funds that have exposure to securities native to that country or global assets. In this way, the international fund of funds gets access to the growth in global markets through diversified mutual fund investments rather than by directly investing in the global stocks. Let's now look at the different types of FOFs available in India. FOFs can differ depending on the fund's investment objective, and we shall be looking at some of the most popular ones. The first being asset allocation funds. These FOFs invest in different asset categories such as equities, debt, and commodities like gold. For example, they could invest in one equity fund scheme, one debt fund scheme, and one gold fund scheme. It helps you to diversify your investments across different asset categories to earn better returns by minimizing the portfolio risk. Next are the international fund of funds. Such FOFs invest in international funds which invest in global companies. Here, investors get indirect exposure to large multinational companies without the hassles of opening a trading account with an overseas broker. In addition, global exposure ensures healthy diversification, which ultimately helps in higher returns. In this case, the FOF fund manager can use the expertise of the fund manager of the foreign fund who would have the expertise of investing in the securities of that specific country. The third type are ETF fund of funds. ETFs or exchange traded funds are mutual funds that invest in shares in the stock market, making it a higher risk fund as they are subject to market risk. Now, ETF based FOFs invest in a basket of ETFs, which means that your money gets invested in multiple ETFs. If one wants to invest directly in ETFs, they require a demat account, while investing in ETF fund of funds has no such limitations. Hence, investing in an ETF via FOFs is a more sought after option than a direct investment in this instrument. The fourth type are gold fund of funds. Here, the FOF invests in mutual funds that are primarily trading in gold securities or ETFs. This category of FOF can invest in mutual funds or gold trading companies directly. Some investors may not invest in gold ETFs for not having a demat account. This is where gold FOFs come into the picture. Gold fund of funds means investing in gold ETFs. Lastly, we have the multi-manager fund of funds. This is the most common type of FOFs available in the market. The asset base of such a fund comprises of various professionally managed mutual funds, all of which have a different portfolio concentration. A multi-manager fund of funds usually has multiple portfolio managers, each dealing with a specific asset present in the mutual fund. Next, let's explore the pros and cons of investing in FOFs. Coming to the advantages first, we have ease of handling. As an investor, FOFs are easy to purchase and redeem as they come with one folio number and NAV. This makes it easy to handle the reduced number of funds that require managing. Like any mutual fund, the price is set and fixed during the trading day. Also, an investor does not need to own a demat account to buy and sell FOFs. Secondly, FOFs are a great opportunity for investors with limited capital. Fund of funds enables investors with limited capital to access diversified portfolios. Typically, you would need to invest individually in multiple asset categories to build a diverse portfolio. These assets would otherwise be hard for such investors to access individually. Thirdly, an FOF is a professionally managed fund. It is challenging for new investors to choose multiple mutual funds since they lack savviness about the market. FOFs invest in multiple mutual funds, whether domestic or international funds. As a result, FOF investors get the advantage of investing in a portfolio that is managed by different fund managers and their research teams. The next advantage FOFs have is diversification. FOFs offer an extra layer of diversification by investing in a range of funds, which further invest in a range of securities. FOFs target various best performing mutual funds in the market, each specializing in a particular asset or sector of fund. This ensures gains through diversification as both returns and risks are optimized due to underlying portfolio variety. While fund investing provides investors with asset diversification, investing in FOFs can add several other forms of diversification into the mix, such as asset class diversification, manager diversification, strategy diversification, geographic diversification, and vintage diversification. Another advantage FOFs offer is convenience in investing in international markets and gold. International FOFs also make it easier to invest in global companies. You don't have to sign up for a separate account with another intermediary to invest in stocks of multinational companies. You can quickly start investing through international FOFs. Similarly, gold funds offer an accessible way to invest in paperless gold. Lastly, FOFs are tax friendly. Another big advantage that FOFs offer is that when rebalancing happens within a fund of funds, its advantage is that it has no tax implication on the capital gains. It is considered an internal transaction. Therefore, when your FOFs are rebalanced to maintain a set allocation between debt and equity, there will be no tax on capital gains. If done externally through redemption and purchase of different mutual funds, it will attract capital gains. Now coming to the disadvantages of investing in FOFs. The first is a high expense ratio. FOFs generally have a higher expense ratio. The TER or total expense ratio is the annual charge that fund houses levy to manage the investments. It is calculated as a percentage of the total assets of the fund. For instance, FOFs that invest mainly in the liquid index and ETF schemes can charge a maximum of 1%, and FOFs that invest primarily in actively managed equity and non equity schemes can charge up to 2.25% and 2% respectively. FOFs incur expenses just like any other mutual fund scheme, but unlike mutual funds, apart from the general management and administrative fees, there is an added expense because they are responsible for the costs of the underlying schemes in which the FOF has invested. Secondly, there is a possibility of portfolio duplication or overlap. FOFs invest in many funds which further invest in several securities. This gives rise to the possibility of the FOFs ending up owning the same stocks and securities through different funds. This situation will lead to portfolio duplication, which reduces the potential for diversification. Lastly, we have lack of flexibility. One major disadvantage of FOFs is that investors cannot choose the mutual funds that a fund manager invests in or the investment strategy. If you don't like one fund, you have no option but to stay invested or redeem your investments if you have already invested. So, if a fund manager has invested in 7 mutual funds, then you automatically get exposure to all these 7 funds. Coming to the taxation of FOFs. Income tax rules divide mutual funds, including FOFs, into 2 groups: equity-oriented funds and other than equity-oriented funds. Typically, an equity-oriented fund must invest at least 65% of its assets in stocks and other equity-related instruments. However, the classification criteria for FOFs are slightly different. Under the current income tax regime in India, a FOF is treated as a debt fund and consequently taxed accordingly. In other words, even if a FOF invests 100% of its net assets in equity funds, the FOF itself is not regarded as an equity-oriented fund and will still be treated as a debt fund, and consequently, the tax benefits currently available to an equity fund are not available to an FOF. The only exception to this rule is if a FOF invests at least 90% of its money in exchange-traded funds, which then invests at least 90% of its assets in shares of Indian companies traded on stock exchanges. It is classified as an equity fund. If a FOF is classified as an equity fund, the tax on short-term capital gains is 15% and the tax on long-term capital gains is 10% for profits exceeding Rs 1 lakh. However, in case a FOF is classified as a debt fund, the entire amount of gain is added to the investor's income and taxed according to the applicable slab rate. Consequently, in case of FOFs investing in equity securities of domestic companies via ETFs, there is a dual levy of dividend distribution tax. Firstly, when the domestic companies distribute dividends to their shareholders, and again, when the FOF distributes the dividends to its unit holders. We now come to the question of how to invest in FOFs. The process is very much the same as all other mutual funds. You can invest directly with the AMC by visiting their office or through their online portal. You can invest through AMFI registered mutual fund distributors or SEBI registered investment advisors. You can invest through online investing platforms and also through RTAs or registrars and transfer agents who process mutual fund transactions on behalf of the fund houses. You can also choose to invest through your Demat account online. If you already have a Demat account, then it can be utilized to invest and trade in the mutual fund in a variety of ways. In conclusion, I would like to say that if you are a newbie investor who wants to diversify your portfolio but does not have the expertise to manage it on your own, the FOFs category can be a good starting point as it allows you to invest in multiple schemes only by investing in one scheme. FOF is a basket of different mutual funds that invest in various assets and securities such as equity, debt, gold, etc. Through FOFs, you do not have to manage or diversify your portfolio independently. The fund manager will decide on your behalf and allocate the money accordingly. FOFs provide access to particular asset categories such as international companies that would otherwise be difficult for investors to invest through regular mutual fund schemes. So if you are an experienced investor, you can diversify your portfolio by investing in international funds. FOFs is a good option for those investors with access to less capital seeking more value through diversification, returns, and risk management. Since FOFs are designed to mitigate risk while offering maximized returns, this opportunity is relevant for those who do not wish to invest directly in the stock market due to the risk factor. However, before investing in a FOF, make sure that there isn't a lot of portfolio overlap with the other securities or assets in your portfolio. It is important to make sure that the investments are well aligned with your risk profile and fit into your overall asset allocation strategy. On the other hand, if you have a predetermined asset allocation in your mind, then FOF may not be a suitable option. Asset allocation in the FOFs is totally dependent on the fund manager's decision, which may not fit into your desired asset allocation. I hope you enjoyed watching my video, and please do like and subscribe to my channel and click the bell icon to get new video updates. Thank you.